morning and welcome to our event. My name is Laura Daly and will be your event producer for this morning. I would now like to introduce you to your event moderator, Lisa Davis. Lisa Davis is the CEO of Pear Securities, a boutique financing firm focused on the junior Canadian resource sector. Drawing on her knowledge of securities regulation gained while she was on secondment to the Ontario Securities Commission and as general counsel for a specialized investment fund business, Lisa is also responsible for the legal and compliance aspects of the firm's business. She has earned her ICD.D designation from the Institute of Corporate Directors and currently serves as a director of Signature Resources Limited. Lisa is also a past director and co-chair of the Finance and Taxation Committee of PDAC and a member of the advisory board for LIGHTS, a program aimed at addressing the shortage of appropriate housing for intellectually disabled citizens. I would now like to turn the mic over to Lisa.
Thanks so much, Laura, and so glad you're here to make sure we know what we're doing and keep us on track. I'd like to welcome everybody today to today's seminar, or panel discussion rather, on navigating the flow-through mining, the flow-through expenditure minefield. It looks like our registration numbers are pretty high, and I think that just shows that there are others around that share the same lack of clarity when it comes to issues concerning the eligibility of expenses for flow-through share purposes. So Pear Tree, as the single largest provider of flow-through capital in Canada, has seen a lot of the thorny issues that can trip up companies issuing flow-through shares. So I'm really pleased today to be able to have the panelists that I'm going to be speaking to today, who are some of the people in Canada with the greatest familiarity and the most experience in grappling with some of these issues, to be able to share their knowledge on the topic today. Laura, any housekeeping things before I go into introductions?
Yeah, actually, there's just a couple. First off is this event is being recorded and it will be available for replay on the Pear Tree website. We will send you that information. And also, because this is a fully live virtual event, we do encourage you to ask questions to the panelists throughout the event. So by using the Q&A icon at the bottom of your screen, you can type in your questions and we'll ensure that Lisa, our moderator, gets the questions asked to our panelists. And if we run out of time live, we will ensure that we send them to you via email.
Thanks, Laura. So I'd like to introduce our panelists today. First off, we've got Kevin Chan, tax partner and national mining leader at PwC. Kevin specializes in the extractive sector and has over 20 years of experience providing Canadian corporate and cross-border tax services to large and medium-sized multinational companies across multiple industries, including mining, oil and gas, renewable energy, and retail and consumer. Next, I'd like to introduce Michael Colburn, partner at Thorstenson's LLP. I think I might have actually pronounced that right. I always have a bit of trouble with it. Michael's practice focuses on corporate and international tax planning, advising Canadian and foreign-based multinational groups on a variety of matters, including financing, mergers and acquisitions, and natural resource taxation. He also has considerable experience in handling tax controversy issues in Canada and a number of other countries. Over the past 20 years, Michael's developed a widely recognized expertise in issues involving the mining industry and regularly advises a number of Canadian and foreign-based multinational mining companies. In addition to his transactional experience, Michael has counseled both taxpayers and governments on legislative and tax policy matters relating to the mining industry. And finally, Rob Stevens, last but not least, Dr. Rob Stevens is a professional geologist and technical project director, facilitator, and policy advisor to the mineral exploration and mining industry. He's the author of the best-selling book, Mineral Exploration and Mining Essentials, and an engaging and skilled trainer who works with governments, industry, and communities. Rob's been a professor and associate dean at the British Columbia Institute of Technology, a director of international programs at the Canadian International Resources and Development Institute at UBC, and the vice president of technical and regulatory policy at the AME BC. He's currently a director of the PDAC and has managed the development of guidance documents, including those of Canadian exploration expenses, mine financial assurance, and reclamation for mineral exploration. So with that, I'd like to just start off with just a quick bit of background. And Laura, you've got a slide there, I think, for us. Thank you very much. Just to sort of put in context how important the topic that we're dealing with today is, this is a slide that shows the percentage of financings for mineral exploration on Canadian exchanges, which are done using flow-through shares. And as you can see, pretty consistently, flow-through shares are, by far the majority of offerings that are used to raise money for Canadian exploration expenses. And in fact, while the numbers aren't final, we've seen some actually growth in that in the past few years. And this year, it appears that we're going to be, somewhere well above 80% of all the financing for exploration funding purposes being conducted using flow-through shares. Laura, can you just go to the next slide, please? So we're going to be talking about some of the issues that are difficult as far as the interpretation of the basic test as to what Canadian exploration expense is and how the proceeds of a flow-through share offering can be used. So just as we get started, the essential test is that CEE is an expense incurred for the purpose of determining the existence, location, extent, or quality of a mineral resource in Canada. And while there are some specific examples of what CEE can be used for, for the most part, we're looking at a so-called purpose test. And everything comes back to whether the purpose of the expense is for exploration. And that's where, we really get into a pretty, wide area of scope for CRA to interpret how this definition is applied. So with that, Laura, I think we can get rid of the slide and move on to our panel discussion. CRA has provided some published guidance on what CEE means and how they, will be applying that definition. They've fairly recently come out with something called the Mining Expenditure Review Table, which, does provide guidance to the industry. But I'd like to start off with a question for Rob, who's been very involved in working with the PDAC, AME, in engaging with CRA and NRCan on trying to improve some of the guidance that's been provided to the industry. So Rob, for those who are not too familiar with this, maybe you could just give us kind of a quick overview of what the table is supposed to be doing in terms of, helping the industry with this confusing area, and where you see problems that are still arising, even though we have that guidance.
Yeah, perfect. Thanks, Lisa, and good morning, everybody. Really happy to be here. So for those who aren't familiar with this table, in 2019, the CRA released a mining expenditure review table that essentially lists a whole range of expenditures or exploration activities, and then provides CRA's interpretation of the eligibility of those activities as CEE based on current tax legislation. And so, at first pass, I think the table is very useful. It's the most thorough guidance we have from CRA on how they view different exploration activities. And I would certainly recommend that companies become familiar with that table and where they can benchmark their exploration expenditures to that table. But as you mentioned, there's definitely some areas of confusion in this table. And I think probably the biggest one that kind of makes its way through many of the items on that table relates to exploration activities that CRA deems were undertaken to assess the economic viability of the project. Now, as a geologist or somebody involved in the exploration sector, I mean, realistically, we think of all activities as having as undertaking those activities for some sort of economic purpose. And if we think of the definition that pretty much all of us use in Canada for a mineral resource, the CIM definition, it includes within it that there are reasonable prospects for the eventual economic extraction of the resource. However, CRA's view, as the purpose test does not really include activities for an economic purpose, and so they could be denied under an audit. And maybe just to give you an example of that, and one of them relates to sampling and time frames. So if we think of geophysical surveys, geochemical surveys, and geological mapping as an example, those generally are considered to meet the definition of CEE, but only if undertaken during the time period from prospecting to preliminary sampling. And that's how it's outlined in the table. So I think we generally know what prospecting is, and that's actually in the Act as well. Preliminary sampling is a little more challenging. It's not a common term that really is used in industry. But CRA goes on to define that, and it says that it means the collection and analysis of samples for exploration purposes prior to the decision to bring a mine into production. Okay, fair enough. But here's the kicker. If that sample is done to help evaluate the economic viability and technical feasibility of a project, then it's not eligible. And I think, well, isn't all sampling and exploration undertaken to assess the economic and technical viability of a project? So that, you know, thinking in the mind of an explorationist doesn't quite make sense. And I think if we take that even further, it also means that any activities, exploration activities that are undertaken after the release of a positive pre-feasibility or feasibility study could be interpreted by an auditor to be related to economic optimization and thus potentially not eligible as well. So, you know, while the table I think is very useful and I recommend companies be familiar with it and use it, benchmark wherever they can to the way it's described in that table, benchmark their own activities. I think it's really important to be aware of some of the limitations and of the thinking of CRA as they put that guidance together.
Thanks, Rob. Before I move on to anything else, Michael or Kevin, anything in particular in the table that stands out for you that is a bit problematic, or issues you've had dealing with clients where they really had to grapple with something in particular in the way CRA has interpreted things in that table?
Yeah, I was just going to add, the like Rob said, that the guidance is helpful in terms of understanding where where CRA sets their goalposts. But as he mentioned, I think many of us would probably disagree with some of the conclusions, or say that, the windows for CE that the CRA's put out there are certainly narrower than what we think Parliament intended when the rules were drafted. So, I think in advising clients, what we typically do, certainly when you're planning ahead for the exploration activities, if you keep in mind that the CRA, if they decide to audit your expenses, oftentimes the auditors that will be reviewing your expenses will look to this table as this is the goalpost. And a lot of them are not familiar with the mining industry per se. So, if you're planning an exploration budget and you have a significant portion of that funded by flow-through dollars, you will want to, just from a practical perspective, try and fit within these goalposts, to avoid any sort of dispute down the road. Now, if you are looking at expenses after the fact, after the CRA has come in and you're trying to defend your position because your expenses don't fit within these criteria, then that's a bit of a different story in terms of being able to formulate an argument that your expenses do qualify. But certainly when it comes to pre-planning, if you want to avoid disputes down the road, you do want to stay within these goalposts. And I don't know, Mike, if you had any experience just from a litigation perspective on the table. I think you're on mute, Mike.
You missed my brilliant insight. I would just add to that, and I think we're going to get to this later, more in terms of sort of, forward thinking in terms of how programs are described in both in public materials and in directors' resolutions. But I think what I would say is that is sort of the one area of focus the CRA has now. If they pull you for an audit, this is something they didn't do 15 years ago, a little bit 10, but they do focus on this. And I think that I would vigorously assert that their position on this is wrong, both from a just a common sense perspective, but also from a statutory interpretation perspective. When you look at all the jurisprudence, it tells courts how to go and assess the language of the Income Tax Act. I just think the CRA isn't right on this, and I also think that I guess last comment is I'm baffled why they continually insist on taking such a narrow, limiting view of this. They sort of think there's a weird gap in the rules, and that by doing so they're limiting access to greenfield, maybe brownfield, but certainly junior exploration companies that the whole purpose of this legislation is to serve. So that's just a bit of arm waving, but I guess to reiterate, I just think they're wrong, and agree that this is sort of the not the low hanging fruit the CRA has, but it's sort of object number one on their list. So.
And maybe if I could just add, to follow from that, I think one thing that I find particularly challenging is that right across the industry, really, we follow the CIM guidance for a mineral resource, which specifically has in it that reasonable prospects for ultimate economic extraction. That is not the definition in the Tax Act. The Tax Act doesn't make reference to that. And it's really contradictory, where different regulatory authorities, in a sense, are telling us to follow different definitions, and CRA is really not following the industry standard, and I think that's problematic too.
I think one of the things that people don't talk a lot about, but these rules were drafted a long time ago, and I think there is law to say that interpretation has to keep refreshing, like outside the constitutional context, but even the regular statutory context, that it has to kind of reflect what's happening at the time in terms of the thinking of the industry legislation is designed, is serving. And maybe the CRA is the one that's stuck in the the Paleozoic, you're the geologist era, but
maybe the Precambrian.
There we go. Yes, exactly. Archean. But so anyway, these are just sort of some editorial thoughts to think about when you're looking at this. But from a practical perspective, I think the advice given here by everyone is be mindful this is it, and be prepared for challenges on the margins of your budgeted program.
You know what? One of the interesting things, and I wonder what your experience like in dealing with the CRA has been in this regard, is that I think a lot of the issue is that the auditors, most of them are not geologists or mining engineers or people who really understand how this works themselves, and it isn't that they're just trying to take a tough, unreasonable stand, but they're really using this table as guidance, because that's sort of all the knowledge that they have. So I don't know if like a little bit of an approach, an educational kind of approach to them is sometimes helpful in the audit process. I know actually PwC was involved with the PDAC going back a few years, where CRA actually was having training sessions, and they brought people in to try to help educate their staff so that they could do a better job of this. So I think they're trying. I'm not sure how much that's helped.
Yeah, I'd say I'd caution against that. I mean, I think we were trying to get a broader understanding of just basic industry knowledge. The challenge we have is they have a lot of these published interpretations out there, including the mining review table, expenditure review table, where they really can't go against any sort of published view they previously had, irrespective of how good they feel our argument is. I think certainly to Mike's point earlier about certainly things changing with the times. I'm not sure they've really kept up with kind of developments in the industry. And so oftentimes when we raise an issue with CRA, and we'll talk a little bit more about it later when in terms of managing disputes, but oftentimes, doing the research to see what guidance is out there, what CRA has previously published, if you can find something that's helpful for your facts, that will actually have a lot of weight in your discussions with CRA, because you can point to something that's been published either in a technical interpretation, in a ruling, or in some other sort of guidance that will be helpful to your position, because they are very kind of emboldened to anything that they published in the past.
Sorry, not to go on about this, but this is prompting more things to think about. One of the issues, I believe, is that the CRA tends to rely wholly on NRCan. They almost abrogate the responsibility in terms of interpreting legislation. I've certainly seen that in both the dispute process and in the rulings process. And so the NRCan, I don't know, people have a lot of experience dealing with them, but when they come to take a look at your mine, and that kind of thing, they'll do tours sometimes, depending on what the nature of the dispute is or whether it's a ruling. There was certainly a generation that was quite literally stuck in the late 60s and early 70s, largely kind of retiring out now. I don't know how that's been refreshed, and I don't know if the sort of the knowledge that so the up-to-dateness of things has really changed much. I don't know how much funding is going to NRCan to support the CRA. I'm not sure. Additionally, at the same time, the turnover of CRA auditors is you've had a generation turnover, and so I think those that did have experience in the industry in the 80s and 90s and 2000s, they're all retirement age now. They have been replaced by a new cohort that are generally in their mid-20s, and they, at least my experience, is that they tend to be quite literal and this to Kevin's point about, even if it's not literally written like the 10 Commandments in the table, they won't turn their mind to sort of think how it might otherwise apply. And I don't know whether exactly why that is, but certainly it's almost like a literalistic view of what the CRA says is law kind of thing. So I think that's probably provides a bit of context as to kind of why we're in these frustrating debates, and we'll continue to have them for quite some time.
So maybe moving on for a minute from the hodgepodge of things in the table, but one of the things, Rob, that you mentioned, and I know whenever I look at this, I find it challenging, is this idea of a sort of a linear approach to how the mineral exploration sequence works, and in particular that idea of a time frame from prospecting to preliminary sampling. And so I find that one of the areas that's really difficult as a result of taking that approach is even when we're looking at expenditures for something like surface drilling, which you think is sort of a no-brainer in this context, but if it's on a property where expenses could be considered to be related to a mine that was previously in operation, or even a property where there's like a separate resource, from a mine that's existing. I mean, this just seems to be like an area that's really, fraught with difficulty. So, Kevin, I know you've been, I think, or your firm's been involved in the recent Westdome decision, which I think might be somewhat helpful in providing judicial interpretation in this area. Can you give us a little bit more background and some comment on that?
Sure, no problem, Lisa. So for those who aren't familiar with the Westdome decision, I'll give a brief overview of the facts and the decision. And in terms of the actual case, it involved the Kiana project, which is currently owned by Westdome, and was the case was first heard in the Court of Quebec, because the dispute centered around whether or not certain exploration expenses incurred by Westdome qualified for this refundable resource tax credit that's available for exploration incurred in Quebec under the Quebec Tax Act. So just for reference, for those who don't have I guess, properties in Quebec. The definition of exploration expenses under the Quebec Tax Act and the Income Tax Act are essentially the same. Just substitute Quebec for Canada in terms of the location of the expenses. And so based on the facts in this case, Kiena was a past producing property that had a history going back to, I believe, the 1930s. It was owned by a company called McWaters Mining, and McWaters operated the Kiena mine until about 2002 when they ceased operations and the mine was put into care and maintenance. And the reason for that was that, at that point in time, all the mineral reserves had been exhausted. So what they decided to do was put the property up for sale, and Wesdome saw an opportunity to acquire the property in order to utilize an existing shaft to carry out exploration activities on a nearby property which it owned. But during the drilling activities, Wesdome actually discovered a completely new mineralized zone with potential located near the old mine. And so the fundamental issue that Revenue Quebec looked at was, were the exploration expenses incurred related to a new mine, or did they relate to a mine that previously came into commercial production or an extension of such mine? And as Lisa showed in her slide earlier, to the extent that expenses incurred relate to a mine that's already previously come into commercial production, those expenses, those exploration expenses, don't qualify for CEE treatment. So effectively, the court had to determine or make a decision on whether or not those expenses qualified, because the Quebec tax authorities took the view that the Kiena mine had already previously come into commercial production and therefore the expenses didn't qualify. So at the first level of court, which is the Court of Quebec, like I mentioned, Revenue Quebec argued that the expenses didn't qualify since the Kiena mine had come into production. And really the crux of their argument was that the mine consisted of not only the ore body, but all the surrounding infrastructure and workings, including the shaft that was used by Wesdome to access those exploration targets I mentioned. And I don't think any of us would disagree that the mine is more than just the ore body, but their view was that because the infrastructure remained in place, the Kiena property never ceased to be a mine, and therefore those exploration expenses that Wesdome incurred didn't qualify. On the flip side, Wesdome's position was that the Kiena mine, as it was at the time, ceased to exist because its reserves had been exhausted, and therefore that the whole complex could no longer be considered a mine. And therefore, the exploration expenses Wesdome incurred related to a new mine and not the one that had previously come into commercial production. So at that first level of court, the court found in favor of the taxpayer, Wesdome in this case. And in particular, they focused on an expert report that confirmed that the mineral reserves at Kiena had been exhausted at the time that Wesdome had incurred the exploration expenses. So their view, and they decided that the expenses incurred did not relate to a mine that had reached commercial production. Now, the Revenue Quebec decided to appeal that case to the Quebec Court of Appeal, which is the second level of court for Quebec tax law. And that court also found in favor of Wesdome, pretty much along a similar line of reasoning as the Court of Quebec decision. And after not winning at the second level, the Crown decided to appeal the decision to the Supreme Court. But leave to appeal was denied by the Supreme Court of Canada, and therefore the appellate court decision stands. So, it's an interesting analysis where certainly, I know from discussions we've had internally and with other representatives from CRA, they're quite unhappy with the decision because it, from their perspective, I'll say broadened what they had previously viewed as what would be considered to be a new mine. And so, it'll be interesting to see kind of how they apply that decision. And I'll get into some comments on my own experience with that. But maybe before I do that, I'll maybe ask Rob or Mike if they had any kind of other observations to add to the case before I provide mine.
I have a number of observations, but Rob, if you want to go first, because I think this is an outrageous position the government took and the CRA takes in this.
Sure, I could.
Yeah, you go ahead first. Yeah,
okay,
please.
let me just emphasize a couple of things that build on Kevin's comments. I've had a number of discussions with NRCan that Lisa talked about around this issue and others. And NRCan, as Michael mentioned, advises CRA particularly on technical matters. And NRCan has, in presentations that they've put out, provided a bit of a list of the things that they will look at around this issue. Is it expiration on a new mine? And so maybe I'll just mention a couple of those. So what do they consider when looking at this and making a decision? Is it expiration for a new mine, or is it just the extension of an existing mine? So was production in reasonable quantities ever achieved? Is the property abandoned or derelict? Has the mine entrance been permanently blocked? Is there a mine closure report? When mining stopped previously, did knowledge exist of additional mineralization? What was the time period between when production ceased and the proposed restart? Will previously developed workings be used in the new operation, and what is the level of usage? And what equipment from the previous operation can be used in the current operation? So there's a bit of a list of the kind of things that they're going to look at and consider when they then turn around and advise CRA on this very issue. And maybe the last thing I'll just say is, because I know there was a question about the guidance document, the 2019 table, and this list that I've just read off. These are available, particularly on the AME website or the PDAC website. And I know that we're going to send something out to people afterwards so that you'll have links to this and you'll be able to refer back to those documents and the things we've been mentioning here. So I just wanted to mention that. But yeah, Michael, go ahead.
Rob,
Yeah.
sorry, quickly, Michael, before you go on, I just wanted to follow up on one thing that Rob said, which I thought, and maybe, there's no real basis for this, but I thought that there was sort of a rule of thumb that CRA applied when they were looking at this issue, that if the mine had been closed for 5 years, that sort of was the time frame where you could feel like you were in safe territory. Is there anything to that?
I didn't get that specific number. That might be their rule of thumb. It seems reasonable to me, although I didn't get them to say that clearly, that that's a threshold that they're looking at, even though it may be their informal threshold. It seems like a reasonable time frame to consider.
Oh, I'd agree with that, except that I have a case where we're fighting over a mine that was shut down in 1971, and everything, all the infrastructure, everything taken out, and they are adamant that it's just an extension of another mine because we're accessing some of the development work through workings next door. Yeah, this is the one area in this sort of top of exploration expenditures or development expenditures, for that matter, really exploration costs and development and workings that drives me completely crazy, where I think the CRA is just and then NRCan completely disregards the law. Like there's 2 leading cases on this: Falconbridge, Supreme Court of Canada in like 1970, and then the Plasterdome case. Plasterdome's, when I'm going to tell you briefly about it, reflect on what Rob was saying in terms of what they look at, and I think you'll come to the conclusion that the CRA just does what they want without any regard to the law. Plasterdome was a strip mine, an old-fashioned surface mine. They're a gold mine. They were sort of, they're doing the usual thing. They're taking off the overburden, the ore deposits. They're mining it all out, and they get to the bottom. And they knew when they got to the bottom, there was more gold down there. They did a bit more drilling and decided, well, geez, you know what we're going to do? Keep on going south. And that's what they did. The CRA came in and said, no, that's all one mine. You knew it was all there. The court said, that's utterly ridiculous. This is, you've mined, you've attacked the mine in this way, you've mined it in this way, you were done. This is now a new mine. Falconbridge is the authority to make you look at connections. And so if you have a certain amount of common workings, that you basically can't operate an existing mine without reference to some other kind of working. So if you're doing building a mine below a mine, which happens in some case, or a mine beside a mine, Falconbridge says, like, well, can you actually develop the mine without and operate it as an economic unit without the mine, other infrastructure next door, or whatever is existing? The CRA just doesn't look at any of that. And I literally have had, day after day, been up in, mines in Northern Ontario with these guys sitting around the table. They talk to the geologists, the mining engineers, and they just kind of stubbornly listen to what you say, and they come back and they write their own thing. And it's an utter disregard for usually the facts, but also to the law that's there. And so again, it seems to be they have a view. It comes out of NRCan because the appeals division says, "It's me, NRCan said it. We can't, revisit this." They take a very narrow view, and I mean, the fact that the CRA is annoyed at Westdome blows my mind. I mean, Kevin, remind me. I mean, Westdome, Kiena, that was flooded. They'd carted things away. You have to go get a dewatering permit. I mean, I don't know how many years to get the thing up in operation again, just to get it dry enough so someone can actually go down and take a look. But I mean, I find it staggering that these folks seem to think that this is like an extension of another mine, or is the same old one that had been mined out long ago. So again, this is not substantively useful for anybody other to hear me sort of whine and complain about this, but I do say that they're very hostile to this, and I just don't know why. Like, I mean, when we had the PPME credit, I could kind of see it because there was some big projects that were going on, and there's a fair amount of money at stake. But like now, it's kind of a nothing, and again, it affects basically flow through now, and I think they're kind of nutty, to be honest with you. I mean, respectfully honest. I have a lot of other things I'd say about it, but I don't want to say that in public forum.
No, and I would say, I mean, it's interesting since the decision, for leave to be denied by the Supreme Court. It's almost 3 years now. We've brought this up with CRA, particularly on new mine disputes, and we say, look, the Westdome decision is quite clear. If you don't have reserves established in respect of the exploration activities you're incurring, the court agrees that that's a new mine. And I mean, the CRA is taking, at least in my experience, a bit of an interesting approach, saying, well, that was under the Quebec Tax Act. The decision is a Quebec Court of Appeal decision. It doesn't have jurisdiction over the Income Tax Act. Therefore, we're going to completely ignore it, and it's not relevant. And I'm sure Mike and Lisa, my legal colleagues, would beg to differ on that. But they're again choosing to ignore the decision that was made that was quite clear. And I think certainly, as we see more disputes in this area, I don't think we've seen, Westdome being used as a precedent in any court case. But, I certainly think that the taxpayer can certainly rely on the commentary there to really kind of stretch the CRA's view of what's considered a new mine.
I think it's a bit rich for the CRA to say that just a sort of an isolated Quebec decision. I mean, they certainly don't hesitate to trot out Quebec Court of Appeal GAR cases, for example, and those kind of things, and say, oh, geez, you can't, this is all abusive because the Quebec court said so. I mean, they're rather inconsistent, I think, in their view of that.
Well, it looks like all of us here are like-minded in terms of the approach. I mean, one of the things I think I'm hopeful we'll see happening in the next little while is there are a few companies now that actually are pushing things a little bit further, and they're willing to go to tax court. And unfortunately, in this industry, there are so many junior companies that just don't have the deep pockets to be able to take a dispute very far, even if they believe that the likelihood of being successful is quite good. So maybe we'll get a couple more decisions, and not just Quebec decisions, that will be helpful, but time will tell. So just moving on to another kind of a related question, again, in terms of this, how do we see things working, like relative to CRA and this sort of linear approach? One of the other areas that I think is really tricky is once you get and forget about being anywhere near a previously operating mine, we'll put this question aside, but once you get sort of a certain ways along in exploration, in a like a greenfields property where you've done, say, a pre-feasibility study, or even a feasibility study, there seems to be this idea that there's kind of like a line in the sand, and anything after that can't be for an exploration purpose. But the other thing where I think there's a little bit of maybe confusion is sort of what happens, like if you have reached that point at which something is no longer going to be considered an exploration expense, what is it? Do you move from exploration expense to development expense where you still, under the flow through regime, or even if you're not offering flow through securities, you have a bit of an advantage in terms of the tax treatment with, with deductibility on a 30% declining balance basis, or right now the first year's 45%, or or is it something else? I mean, I think some people think, well, if it's not E, it's D, and at least I've got that, but I'm not quite sure if that's CRA's view. I don't know, Kevin, as the accountant in the room, did you have anything to say about that?
Yeah, so for those who aren't familiar with kind of where CE starts and where it ends, CRA's view is that, once you've effectively determined existence, location, extent, quality, the expenses no longer qualify for CE treatment. There is, however, another provision under the Canadian Development Expense Rules, or CDE, that refers to costs incurred for the purpose of bringing a mine into production. And so those costs do qualify for CDE, and CDE can be flowed through under a different provision of the Act. The challenge that a lot of us have dealt with historically has been, the CRA has effectively imported a gap between those two kind of types of expenses, which basically says you kind of do your preliminary exploration, and then once you do that and you decide to go ahead with the mine, you would think that you kind of move right into that next set of expenses, which are those kind of pre-production development expenses. But CRA's view is that there's actually a gap in between those two categories, and as Rob mentioned before, that's kind of where that economic feasibility those types of activities typically occur. And so that's created a whole host of issues, particularly, historically, when, these types of expenses all qualified as CE, but certainly for issuers going forward who are looking to fund all of the expenses up until, commercial production. You do need to be aware that CRA does say that until you've made, and I think their words are, an official construction decision, they won't view those expenses as being qualifying for that CDE treatment. And so, I think certainly if you look at the legislation, there's no requirement in the legislation that, a construction decision be officially made. And how do you evidence a construction decision? So oftentimes during the course of an audit, the CRA will say, we want to see board minutes, we want to see directors' resolutions, we want to see a press release. And so, I think being aware that CRA does have this gap in between the exploration and development expenses that doesn't qualify for flow through is really important. And so, I don't know if Mike or Rob have comments on that, but that's certainly an area that we've seen CRA focus a lot on.
I have some strong opinions on this as well. I think the CRA is wrong in believing that there's a gap between the F and G rule, the exploration and the development rule. The reason I think that, and I think a court will agree with that, is that on the exploration side, their interpretation ignores the word quality resource. And I think the preponderant view of not just industry, but I would have thought, like even sort of neutral experts in the areas would say that any reasonable interpretation of the word quality in the paragraph F of the rule would require an assessment of whether or not you can actually make money off it. Otherwise, it's just some random theoretical exercise where someone's, mapped a bunch of earth, which is great, but it's kind of useless. And this is an economic statute we have. These are economic rules that are there to deal with the extraction of this, not to just sort of do an academic exercise and drill some holes and do a nice little spreadsheet as to what we think we got there. So that's why I think it's F anyway. But to the extent that they think it falls between that, I don't know how you lose it falling into the development expense categories for the purpose of bringing the mine into production. And I think if you say, well, quality, maybe it should be kind of limited to more greenfieldy kind of stuff, not production-y kind of stuff, which again is a bit of an arm-waving argument. How is not informing yourself to spend hundreds of millions, if not billions of dollars for the purpose of bringing the mine into production? They would say that they look at, well, you've made the decision, and so therefore, that's they draw the line. But I think again, they're trying to stretch. They're, you know, these words into kind of out of context and without any regard to why they're all there. This is an incentive regime. It's there to raise money. It's there to, I mean, obviously you can write stuff off a lot faster than otherwise. I mean, if the government really did want to take a restricted view, they make it very clear that these things aren't deductible or something like that. I mean, it's, I just think they're wrong on that. I mean, there are cases going forward in the BC METC context and that I think will likely bring this to the fore. And certainly if not, I think there may be others in the pipeline, federal even, that, I mean, finally, I think there's enough, a couple taxpayers anyway, that have enough balance sheet to be able to actually resist the CRA view on this. So yeah, I don't think the court's going to agree with them. I'm, again, as I said earlier, a lot of these, I'm baffled why they feel like they have to take such a restricted view of this, but you know, they do. And it's nothing new either. I mean, this has been around for a decade. And it's a little bit surprising it hasn't been litigated yet, but going to Lisa's point is likely due to the fact that it just, you know, the risk reward for, you know, someone who's stretched already and really needs to spend all their money on stuff in the ground, you know, it's kind of an easy, I can see why it hasn't, but that's my sort of hot take on that.
Thanks, Michael. So obviously, it's come up throughout the conversation in terms of CRA's view and there not having been, you know, adequate judicial interpretation. So I'd like to maybe move the conversation into some managing that process when CRA disagrees with a flow-through share issuer about the categorization of expenses claimed as CEE. And I guess there's a couple of sort of aspects to that. Like aside from the substantive legal issues, there's definitely some strategy involved in you know, deciding how to resolve a dispute with CRA. So maybe Michael, I'll turn it back to you because you're the most litigious one in the room. See what you have to say. See what you have to say about the, you know, the approach when you're, you know, you find yourself sort of early stage in that, and sort of what, you know, what are your options and strategically, what do you recommend?
Yeah, so I think so even bearing in mind, I think it's fairly clear where the CRA's views on this will fall. I think sitting down and spending a little bit of time thinking about how things are documented is a good start. So we think about an audit runs and how they, you know, it goes into the judicial process. I mean, ultimately, what's written down on pieces of paper contemporaneous with decisions are things that are accorded the most weight by the CRA, yes, but most importantly by a court. And so how you characterize things, your exploration program, how you describe it, matters a lot, and then public communication as well. And so I guess the rule of thumb would be, you know, like you say, look, we are, you know, how do you dress up a feasibility study? Well, bottom line is you kind of don't, but I'm sure that, you know, in terms of you know, describing to the public what you're doing with other things like, you know, you know, whether or not you have a new mine, for example, or whether it's just simply you're de-risking a project because you're extending a prior mine. You know, thinking about how you articulate that in terms of how that fits into CEE is a really important thing to do early on. And so I guess the, you know, big point being is managing communications with a mine that each and everything that is written down and either disclosed publicly or is in your, you know, in your records that aren't privileged will be looked at by the CRA someday and will, you know, can be held against you in a sense. And, you know, things like, you know, decisions. I saw, you know, going back to Kevin's point about, you know, construction decision. You know, I've seen a dispute when that, from the CRA's perspective, when the gap ended, when D started, and then there was a, you know, a confusing number of directors' resolutions that, you know, were sort of contingent on certain the events. So like the directors decided at a meeting in, I don't know, like June, that they will, you know, they agreed that they would proceed provided that, you know, a Quebec approval for something was given or something like that. And so, you know, had we been sitting there back in June, we might have, you know, probably made a hard decision, maybe make no mention of the contingency. You know, you tell the directors, hey, in that circumstance, you're going to be unable to actually proceed if, in that case, Quebec doesn't give you your, whatever license or permit. But at least here you can point to a very clear decision point, so that you at least fall from the CRA's view when you're starting. So this will be covered. It's that kind of thing. And so I guess I mean, obviously, it's facts and circumstances, and what peculiar expenditures you're talking about, and the particular provision will, how you articulate things will matter based on those facts. The big message is, think about two categories of expenses. Think about what your objective is. I mean, if you need CE, really think hard about whether it's in or not, and then about articulating it, and even in internal email correspondence and that. I mean, I don't want to sound like I'm some sort of paranoid person, but that's the starting point where everything, is built upon. The foundation are these written communications. And so I would just say, be mindful of that. Most companies work very closely with accounting firms like Kevin, involve them early. And because they know the area, they have the day-to-day experience of what the CRA will do with particular expenses. Get them to help you shape your narrative. Do that all orally over the telephone, so that you don't have a record of being fed, ghost written by an accountant or a lawyer. And but put that investment up front. It's not a big investment, but I think it's a worthwhile one, and it'll shape the dispute later on.
What about, I mean, I guess maybe this is a way of avoiding disputes, but what about applications for advanced tax rulings and all of this? I mean, I don't know right now, because it changes from time to time as far as what the wait time is just to get that done, and how practical it can be, particularly when you've got a short financing window. But I don't know if Kevin, this would be something you would be most familiar with, but in terms of just the practicality of the whole thing, and what, like, when you see that might be a useful approach to avoiding disputes.
Yeah, I think the CRA, I mean, pre-COVID, the CRA's guidelines around rulings were, I believe it was 90 business days that they agreed to provide a ruling from the time they received full information. Now, obviously, with the pandemic, I think that's probably been stretched. I will say, I mean, just based on my experience, I think it's pretty rare that I've seen an actual ruling done, just because of timing around wanting to time the market in terms of getting an issuance done, having if it's doing a private placement, making sure that you get the funds in before undergoing a drawn out process. So I personally haven't done one recently. I'd say most of our dealings with CRA have been more on the back end when they've come into audit, and unfortunately, as I mentioned earlier, they're very restrictive in how they interpret the rules, in particular based on their past administrative policies or things that have been published. So one of the trends that we're seeing now is we're actually advising clients, look, for those who aren't familiar with the process, what happens if you get audited? CRA typically issues a reassessment. And you have, from the time you receive your reassessment, you have 90 days to file what's called the notice of objection. When you file that objection, it goes to a independent part of the CRA called the appeals division. And the appeals division is meant to look at your appeal separate from the audit team and come to a conclusion on whether or not to confirm the reassessment or adjust it based on your representations. And I'll certainly say, in my experience, given it's still the CRA, typically if there's a published position on things like construction decision or feasibility studies, they will not change their view at the objection level. So if your notice of objection is confirmed, or sorry, if your notice of objection is denied and the reassessment confirmed, you then can file a notice of appeal. And that starts the litigation process. And I'm sure Mike could speak to it more, but once you file that notice of appeal, there are some avenues you can take to accelerate the dispute. You can also accelerate earlier by even kind of jumping over the objection process. But one of the things we found is, because ultimately, if this goes to court, the Department of Justice gets involved, and they have to weigh kind of the cost benefits of proceeding with the litigation based on their view of the likelihood of success, which can oftentimes, once you get into a legal discussion, can be very different than how the CRA would view it. So we have found that sometimes engaging in discussions with the Department of Justice, particularly around settling an issue in advance of going to court, because even though you may feel that you've got a really strong position, there's always that risk that with any sort of litigation that you won't win. So we've also heard that the tax court in particular has a backlog of cases because of COVID. So the Department of Justice really is trying to get through that backlog, and the way they're doing it is entertaining, I'll say probably more so than previously, settlement discussions with taxpayers. So sometimes it is better to, and more efficient to leapfrog the CRA and just really directly engage with justice on those discussions, because you might get a quicker result and a better result based on a legal analysis of your position. I don't know, Mike, if you've had any kind of experience kind of going through that process.
I do. I guess the first observation would be I haven't done a flow-through ruling. I've done ruling applications for new mines for other purposes and have withdrawn them because of the loggerheads that we came to with NRCan. There are very few actual flow-through rulings in the database that's published, redacted one. And so, I mean, I think that's right as a consequence of time demands and the like. In terms of, what Kevin was saying, what happens in dispute process and what to do. Again, my own experience has been that appeals it's very difficult, and they pitch everything NRCan. I've had some very good success quite recently at the Department of Justice level resolving old issues. Like we had actually a CEDO issue relating to resource allowance claims. So it wasn't flow through share, but it was quite a question of whether a bunch of underground operating costs, development costs were in or out of CEDO for purposes of the old resource allowance for 2001, 2005 taxation years, which is, that's pretty long ago, right? We're talking 15 to 20 years ago. We've got very good traction. The CRA was dug in literally for 15 years on it. And to the point where we were actually yelling at each other at various points. The various appeals officers would roll through the file because I refused to give up on it. And then finally, we just got frustrated and filed an appeal to tax court, which was risky because we're dealing with tax years now, going back 20 years, and 2 takeovers later, and everyone's retired or dead, and there's no information around because it's it was on like an old floppy disk or something like that. So it's been a bit of a high risk kind of thing in some circumstances, but it's, for whatever reason, there's a one lawyer in Ottawa who it seems is getting a lot of these files related to the resource companies, and she's settling them, and she's very good. She's not, she obviously doesn't roll over, but I think her, she's looking at these things and saying, realistically, the effort that the government has to put into to maintain its position against a well-funded taxpayer is just like, what's the point? Eats up a huge amount of resources, expert fees out the yin yang to an uncertain result. And I think if you're seeing the groundwork gotten on the CEDO stuff, you'd say that, there's certainly someone there, at least on the justice side, is like, look, this is just a better way out. So yeah, the unfortunate thing is when you get to that point in the process, it's just so bloody expensive paying your own counsel. And again, that's just not because, just because that's just legal fees and that's just time. It's not any kind of weird premium or anything. It's unfortunately, the slog of that stuff is just muscle work. And so it just takes hours and hours of people going through god awful, accounting documents and trying to hunt people down on that the fees go up pretty much. And so, I think there really has to be a lot at stake if you get that far in the process, where it's either that or else, you have a taxpayer who's just as a matter of principle just had enough. And, obviously as a lawyer, you like that kind of person because they'll spend anything, cut their nose up to spite their face. But yeah, it's not an inexpensive process, unfortunately.
So maybe, at the heart of this whole conversation, and I think, of primary interest to resource companies is the ability to raise capital. And so with looking at the challenges that we see from CRA with regard to the characterization of expenses in the context of flow through share raises, what can you say about like the actual, the flow through share investors position when something starts going sideways, because we've got like a company that's, you know, been the one that, you know, is spending the money and has kind of the knowledge and the control over the whole process. Yet under the Income Tax Act, the you know, the effect of issuing flow through shares is that the expense is deemed to be taken by the investor in the flow through shares. So eventually the result is that they're reassessed, and obviously, you know, don't even know about a lot of this until like quite far down the road in the whole process. So I wonder if any of you have any particular comments just in terms of sort of how things play out from the investor point of view, and you know, advice to issuers about how to you know, take a position and take steps to try to, you know, minimize the negative impact to investors when anything like this occurs.
I think I mean, one of the key documents in the flow through packages is the, you know, the indemnity provisions, right? And so in the worst case, from an issuer's perspective, you have an investor that gets reassessed, but the indemnity makes them whole anyway. The investor could care less because they don't care, you know, what happens as long as they get their check, as long as the issuer is solvent, they're indifferent, which isn't great, because then the issuer doesn't have much control over ensuring that the you know, investor deals with the dispute on a timely basis, that they take it seriously. And so, I mean, I think the ideal thing obviously is in the indemnity provisions, in that is to ensure that that no indemnity is paid unless the objector, you know, complies with all, you know, objections in that, and that the carriage of the matter is in the hands of the company. This is pretty old standard stuff, but that's kind of the key thing. And then when this happens, it actually turns into a bit of an administrative, I don't want to say nightmare, but just it becomes an organizational challenge, because you have to then communicate with, you know, with everybody. They may or may not have been opening their mail. I try to avoid opening anything from the CRA, and you know, with sometimes great regret. And so to make sure that things are being done, and then try to, you know, get people who are, you know, diverse from, you know, mom and pa doctor and dentist, or whoever is buying these things that are disorganized, to make sure that you know, the system goes and nothing falls through the cracks. So if this is coming down the pipe, I think it's ideal from an issuer perspective. Get a system in place so that things are ready, communication plan, and just, you know, have someone tasked, or more than one person tasked, with actually making sure that investors are followed up with, that they get their copies of the notices of assessment, that there's a draft notice of objection that's sort of prepared, that applies for everybody, and that, you know, you have control of the carriage of that. And then, I mean, the other part of that, as I said, we talked about pricing earlier, is to try to, you know, when you get your advisor, whether it's an accountant or a lawyer, to try to get some kind of, you know, terms on that, you know, that the costs don't run out of control. I mean, again, as from an issuer, you want to try to push that risk onto the professionals as much as you can. And so, I mean, I'm not, you know, Kevin's probably wincing as I say this, because I know my partners would kill me too, but lawyers generally charge on an hourly basis. And if you have hundreds, I mean, this stuff, it can be like a complete black hole, like flow through shares. There's been a couple of those, but certainly the more syndicated, regular old tax shelter stuff, it was unbelievable. It would get run out, because you have, you know, hundreds of investors and this and that, and they're, you know, on the phone all the time. And if it's being done hourly, you're going to be writing checks until you run out of money. So I think again, to try to push that risk onto the firms, to get them to put discipline on them, come to you with a proposal, and let them control the costs and that, and have a strategy for dealing with that would usually be ideal. Sort of watch your own pocketbook.
And you know, I think hopefully the message to the audience is, look, you know, as we were saying earlier, you know, plan ahead, right? So, you know, it can get very messy, as we've been talking about. So, you know, if there's an ability to fund expenses that clearly fit within those goalposts that Rob was going through earlier, and that are in the table, you know, again, you know, no matter how much, you know, Michael and I and Rob and Lisa, we all agree that CRA is wrong. the, the cost of getting it litigated and disputed with CRA is immense. And so if there's an ability to fit your exploration budget, or at least fund the flow through piece through, we'll call them good expenses, then certainly, and then you fund maybe the rest of your exploration budget with hard non-flow through dollars, then certainly that's kind of the best kind of approach, because we can all sit here and say we disagree, but ultimately CRA is going to take the view that they've taken, and we've certainly seen them take a very hard line on this. So a lot of the stuff we're talking about is, okay, well, if you kind of happen to find yourself in a dispute, then this is how you manage it. But certainly, documentation, I totally agree with Michael. You want to do that contemporaneously, and make sure that your advisors look at that, and also coordinate with the other departments within the organization. The last thing you want to do is send out a press release that completely blows up your flow through argument or your CEE argument. So, really important for communications, particularly out to the market, through investor relations or through community relations departments, gets vetted appropriately by legal and tax advisors, or even by the finance department internally.
Oh, Rob, did you
I just might re-emphasize the comment about you may well expect, particularly if you're getting on the fringes of the core activities that we know meet the purpose test, that some activities or expenditures may be denied. And so I take Kevin's point about if you've spent your flow through right to the end and you have no latitude, that you may run into challenges. So if you can spend some hard dollars on a little bit to give you a little bit of buffer there, or particularly those activities that might be, while again, we would feel that they're definitely core exploration activities. If CRA doesn't feel that way, then that's a pretty safe strategy. And your communication, as you said, one example would be if you're drilling for multiple purposes, for example, expansion of a resource, that's clearly meets the purpose test. But if you're also going to be doing metallurgical and geotechnical tests on the same core, then you may be getting into some gray zones depending on how that's interpreted. And so separating out invoices, having them clearly articulate the activities, don't put them all together, because if they decide geotechnicals for economic purposes for mine development, then the whole, all of it will get denied. So kind of be smart in how you separate those different things out, because as Kevin also mentioned, once they're denied, it goes to appeals. Well, maybe not much is going to change. So you're best to catch it up front, I think, and try to be really careful in how you articulate your invoices and your description of activities, as was mentioned earlier.
You know what, we're getting some questions in our Q&A little chat box here. So I'm going to want in just a minute move on to that, but I did want to comment, as a firm that's done, so many flow through offerings, we've had the, fortunately fairly rare experience of having to deal with situations where there has been a reassessment and appeal has been unsuccessful, and things have actually moved to the litigation stage. And I can tell you that I've seen like very different approaches from issuers, and the investors really form pretty strong views as to what they think about that issuer and how they're going to talk about that issuer as a result of the experience they have. And one thing, Michael, that you pointed out, I mean, there are very general types of indemnification provisions in the flow through share subscription agreements, and I think we're starting to make progress in terms of changing the industry standards a little bit to refine those. But the best outcomes have been when everybody is collaborative, when the issuer doesn't sort of dig their heels in and try to find excuses to not pay the indemnity, and when the investors don't want to cooperate with filing notices of objection. But when everybody sort of gets on the same page and works out a process, that's the best outcome. And we've actually you know, there's one situation where I think we had about 90 clients involved in something, and the issuer was great about it in terms of writing checks, including for interest. But, you know, we stepped up and said, you know, we'll help you with the admin. Like, you know, we are all in this together. We all want our clients to be happy. And, you know, I think though we are starting to see some changes to the way those agreements are drafted, because having, you know, everything clearly laid out up front is definitely the best way to go. So having said that, we do have a number of questions that have come in. You know, I'll start, we've got one that it's somewhat specific, but it is an area that I know has been an issue, and there's actually some specific items in the mining expenditure review table, and there's been some other guidance from CRA on this. And that's the topic of community consultations. And this question is whether or not for CEE under community consultations, whether arrangements and contracts with First Nations in the area of an exploration project can be acceptable as CEE. And I think we got a couple of those. This asking about the same thing, examples of environmental and community relation expenses that are and are not CEE eligible, and also sometimes I think there are certain payments made under IBAs with Indigenous communities that could be, you know, even sort of after the entering into of those agreements, and so also the same topic in terms of how CRA views those community consultation expenses.
Yeah,
Rob,
I can maybe make a couple of comments on that.
Sure.
Yeah. So, I mean, I guess just so everybody knows, the allowability of some community consultation and environmental studies expenses was brought into the Tax Act in 2016. And I would say that's after quite a bit of lobbying by organizations such as the PDAC and AME and industry generally, that these were now core activities to a modern exploration program. But as the questions are, the devil's in the details. What is actually the allowable expenditures that would, that CRA would accept as CEE? So in the original 2016 guidance, it indicated that environmental assessment and community consultation activities undertaken to meet a legal or informal requirement to obtain a permit would meet the test. Then, unfortunately, in the 2019 table, they removed the word informal. And to me, that's meaningful, because if we take, for example, early engagement with Indigenous people, that is best practice and strongly encouraged, but it's generally not a formal requirement to obtain a permit. So that has left some area of confusion now around when those expenditures would be eligible. With that being said, there was a technical interpretation that was released by CRA in 2018 that was based on a hypothetical scenario. So it is a hypothetical scenario, but it does outline some of the types of expenditures that CRA will consider CEE in the area of community consultation and environmental studies. And it includes things, they make some commentary on capacity payment expenses, ongoing consultation expenses, environmental assessment expenses, and legal documentation expenses. So again, that'll be out in the material that we send out. Particularly if you look at the AME guidance document, there's an area in there on this particular topic, and there's links to those guidance. So I think if people take a look at that, it'll give them some idea of how CRA is thinking about those types of expenditures.
Thanks, Rob. And actually, you mentioned, I'm glad you mentioned just in terms of being able to access some of those resource materials through those links, because we did get a question as to whether there's anywhere specific in terms of website accessibility to find previous CRA rulings or technical interpretations. I know there are paid services for that. Is there an easy way to access all of these things without a paid service?
I
Not
mean,
that I'm aware of, unfortunately. I know,
yeah.
Kevin. Yeah.
No, there is one site, I think it's called taxinterpretations.com, and they have some select interpretations, but they also have a paywall for kind of everything. So I know at the firms we use a paid service from CCH or Carswell. So,
Yeah.
but otherwise, I think sometimes if someone's written an article on the particular topic, there might be something that can be found through a Google search. But generally speaking, I think certainly there's paid services out there that have access to the material, but it's publicly available.
And I would say in the AME guidance, some of that, the ones that are linked in there are generally available. In fact, I was able to access, I don't have a paid subscription to that, and I was able to access off taxinterpretations.ca or .com that file yesterday. I also think they used to have something where they were all free for the first week of the month or something like that, and then there was a paywall after that.
I think that's right, Rob. Yeah.
Yeah.
Right.
So it's a little bit frustrating. CRA doesn't maintain its own library of that, given that they're their rulings, but they rely on others to do that.
Hey,
And others do that on an access to information request basis, believe it or not. They refuse to put anything out because they think it's a breach of taxpayer confidentiality, and so it's just unfortunately I don't think it'll ever happen. They're not helpful.
no, that's too bad. So coming back to another question about recent trends, what would you say is approximately the percentage of flow-through share expenses that get audited by CRA? And I guess you could look at that in different ways, like how many issuers are audited, or maybe thinking of one of the comments that Rob just made, like we always want to know that when issuers that we're dealing with are budgeting, that they've got enough hard dollars or funds that can give them a bit of a buffer, thinking if I'm if 10% is denied. So if you're trying to sort of plan for that and say, if I'm doing things that seem, the like best practices, what would my kind of buffer be? Like, is it, if I'm audited, is there, 10% usually denied? Is there any sort of, any rules of thumb there?
I mean, from my perspective, it's really kind of a company decision in terms of appetite for risk, right? Certainly if dollars are hard to come by and every dollar helps and you can only do it by way of flow through for the premium, then I think certainly you might have to have a higher risk tolerance. I mean, in terms of the question around percentage of actual issuances that are audited, I will say, at least in my experience, and this would be pre-pandemic, I would say that if your tax service office was Vancouver, in particular at West, I've found the CRA quite a bit more aggressive out there in terms of auditing flow-through share issuances. I haven't seen as much activity here in the GTA in particular. I will say since COVID, and with all of the stimulus money that's out there with the wage subsidy and the rent subsidy, I do know the CRA has redirected a lot of their audit efforts to kind of those particular areas. So I think certainly we've seen the number of flow-through share issuances that are being audited decrease. I don't know, Mike, if you're seeing the same kind of trend, but that's kind of based on my experience.
Yeah, I don't really have the same sort of view that you would have, and so I don't know. I don't have a sample size. I just get things when they go south. So yeah, no one calls me if things are going well.
And what's up with the Vancouver office? Is that some relic of the Vancouver Stock Exchange and Howe Street or something?
I mean, my take on it is it's just a function of the number of issuers relative to, I'll say, the larger size taxpayers. Like certainly in the Toronto Centre office, you've got all the big banks, you've got a lot of other large significant taxpayers where the CRA focuses its efforts. Whereas I'd say junior mining companies probably make up a bigger percentage of the population of audit targets within that center. So I mean, that would be my only kind of guess.
And they're less likely to fight it. They just don't have the resources.
Yeah. So I mean, that's just my own kind of personal observation though. No historical data to back that up.
Looks like we've got one more question that's just come in, going off in a little bit of a different direction. If an issuer's had an audit from Revenue Quebec on their refundable tax credits, like under the Quebec Taxation Act, can they leverage off of that audit if they're ultimately audited by CRA for flow-through share issues?
I would say, as a tactical matter, absolutely. First thing you say is, "Why are you bothering me?" We've had Quebec go up and down me one side or the other. It's wasting my time and yours. I don't know how the CRA respond to that. I haven't had that opportunity to make that. But based on what Kevin said earlier, I wouldn't be surprised if they, may say, "Well, that's good for Quebec. We still have to do our job," kind of thing. Kevin, have you been able to make that kind of assertion successfully?
Yeah, no, I would just say that, my guess would be they'd probably take it under advisement, but I don't think they would necessarily make their decision purely based on how Quebec did their analysis. Certainly our experience in raising Westdome has kind of shown us that, they'll say it's a different piece of legislation, particularly if they disagree with the answer. They'll say it's a different piece of legislation. There's no precedent that we're relying on. They have to follow Westdome, we don't. So I can see it being entirely possible that that they wouldn't necessarily just follow, but can an issuer leverage off the analysis and the audits? Absolutely. And certainly I think if it were to go to court federally, I think that would certainly have weigh heavily on some of the discussions you would have with justice, because I think a justice lawyer certainly would be a little bit more sympathetic if they've known that Quebec's kind of audited kind of all the way through and signed off. So
Okay. Well, I think the only other area, just in terms of questions, that maybe we can take a minute to talk about before we come to the top of the hour when we're due to sign off is, and we talked a little bit about how issuers can best equip themselves to be well positioned in the event that CRA comes knocking, or even if they come to litigation. But one of the things that I think is sometimes difficult is sort of the coordination of people within a company, because you've got sort of IR wanting to make some comments, you've got geologists that are doing things like only with reference to kind of their area of technical expertise. You've got, we talked a little bit about board proceedings and what that looks like. You got press releases that obviously, companies want to get out there and make it, sound like things are advancing, as sort of aggressively as they can. So any sort of parting words with regard to, how to deal with those sort of different areas in a company and hopefully be in the best position you can if you've got to deal with any of this dispute stuff?
Other than start early and to have it on the yellow sticky on your computer, not really. I think it's sort of things happen, you have to kind of react, but I just be mentally prepared for the kind of thing and think about how you organize it, really. So.
Yeah, I would maybe build on that. And I always like to start as a geologist to just remind the geologists or the technical teams that CRA doesn't quite think exactly the same way. And so, obviously we can get annoyed with that. But in the end, it's best to then put your mindset into, what CRA's language is, going back to the 2019 table, benchmarking your activities as much as possible to the purpose test, to that table, and the way that it's going to be viewed by an auditor. Common language to describe invoices that even goes to your contractors. What are they describing was the purpose or the nature of that work that they've done? Even the accounting codes you might set up internally, the contracts and agreements. I understand if you have big engineering contracts, those are the types of things that may be scrutinized, which may even come down to subcontracts. So just being really careful with your wording, and that everybody is aligned, accounting, IR, geologists, in common language, I think, and benchmarked again to the purpose test and the language that CRA uses is I think, a good way to help avoid some of those challenges.
And maybe just to add on, as the accountant on the call, have some controls. Have some controls in place to make sure that you have that communication between the various departments. So someone, in finance or tax should be reviewing documents before they go out, either through press releases. Have a scrub of your website. When you list that you first came into production, it's, distinguish between a new mine and a previously producing mine if it's on the same property, things like that. But I think importantly, have that control, whether it's reviewing invoices for descriptions, as Rob said, or any sort of other kind of controls that can help you, I guess, put yourself in the best light when and if the CRA comes to audit, which can be, a number of years down the road, right? So, doing that all in advance and just being prepared. You never want to hope to be audited, but you want to be prepared. So have those controls in place before things get too far down the path.
Thanks. Well, listen, I want to thank all of you. I think, you raised some really interesting points, and I hope that our audience learned a few things this morning. I know that, and maybe Laura with final housekeeping may chime in on this. The materials that we referenced today, primarily that CRA mining expenditure review table and some guidance from AME with links to things that hopefully are not behind a paywall. I think we're going to be making available, and I believe we're going to have them on Pear Tree's website as well. I do want to, as one sort of parting bit of information, just mention that on Pear Tree's website, there is access to a petition which we're currently sponsoring, specifically with regard to the potential for a capital gains inclusion rate increase. And as that would impact flow-through shares specifically, because we strongly believe there'd be a disproportionate effect on financing for exploration, given that flow-through shares have a deemed zero cost base, and trying to make the government understand what the sort of unintended consequences of that could be, specifically with this, for this industry. So I would encourage everyone to just hop onto our website and take a look at that and support the cause. And otherwise, once again, I'd just like to say a big thank you to Kevin, Michael, and Rob.
Yeah, thanks very much. Thanks, Lisa.
Thanks, everybody.
Thanks for
Bye-bye.
having us, Lisa.